Hi everyone, welcome to the Joseph Mews Property Market Roundup, where each month we take a closer look at the headlines that are impacting the property sector. So today we're going to be talking about some of the headlines that were impacting the market in January, and we're proud to announce that this is the first episode of our new rebranded industry roundup with as Joseph Mews. It's been an exciting time.
It has been a really exciting month. We've had some good levels of inquiry and some interest in the new developments. So great start to the year, and our first branded products as well.
Absolutely. We've all got the branded umbrellas out there, so if you see a Joseph Mews umbrella, feel free to take a shot, because they are beautiful. So we'll jump straight in with the first headline, which has been a thing that most people have been talking about, and that is the potential for rising interest rates after they rose to 0.25, which is up from 0.1%. So it's the first time they've risen since the beginning of the pandemic, and obviously they have a big impact on the property market, and we can't really rule out the possibility of them increasing more. So Callie, what do you think this means for investors?
So I think the first thing we need to remember is that they are still incredibly low compared to what they've been in the past. And they were at kind of 1% at one point, so still not as high an impact as if it had gone up to those heights again. The other thing is that, buy-to-let mortgages are still at some of the lowest rates ever, so it's still quite an attractive market for investors, although it does make it slightly less attractive for home buyers with those higher interest rates. However, obviously with that, it does kind of stimulate the rental market again. The other thing that we need to mention is that, yes, interest rates are rising, but also so are rents. We've seen some huge increases in rental prices over the last 12 months and obviously before that. So that should compensate for the rise, I think.
Yeah, absolutely. I think you've got to think that as the rental market grows and there is that more demand, then there's always opportunities for investors to incrementally increase to sort of match the rise in interest rates and still make a profit on their investments. Which, talking about rents, London, unfortunately, rents have hit a 7-year low in the capital. They're at their lowest average since 2015. And this is despite most regional areas, in the UK seeing increases. So what do you think is causing this drop in rents in London, and what can we expect from the rest of the market?
I think there's a few reasons, really. I mean, last year we know that a lot of landlords in London were forced to lower their rents anyway, just because of the pandemic and obviously because of furlough. So there's kind of that reason behind there. London rents and London prices have kind of been at a bit of a discrepancy for a while now, so it's not something that's unexpected, and I don't think it will be forever, to be honest. No. London is London at the end of the day, and I'm sure it will go back up eventually. But it's making a lot of regions a lot more attractive to investors, and London a little bit less attractive. For entry prices alone, when you look at places that are seeing huge increases in property prices like Birmingham and Derby and other Midlands areas especially, it really highlights the investment cases for those regions. The other thing, we've been seeing for a few years now, people are moving out of London as well, and I think that was only kind of increased by lockdown, with people looking for more space. It's something we spoke about quite a lot last year. People get more space out of London for their money when they're renting, so it makes it a lot more attractive and obviously less attractive for investors. So as I say, it's a cycle. We'll probably see it go back up at some point, but at the moment it does make other places more appealing for investors, I think.
Yeah, absolutely. So the biggest drops were in SW1, which obviously is quite central. Rents have fallen by 20% there. So it's one of those things that is also impacting central London, which is, when we talk about this kind of thing, tends to be the case. But yeah, as you say, I think it shows that the London exodus is probably far from over, but at the same time, you can never count the capital out. And for investors, it's always a good time just to consider these alternative markets that are affordable, offer good entry points, but still the returns that they expect from their investment. The big news obviously last year was about the pandemic boom. So obviously sort of house prices were hitting record-breaking levels. Transactions were up an insane amount because of the demand that was coming from the pent-up demand that they call it. So I suppose the big question that still in everyone's lips is the pandemic boom going to continue? Is this the end? What do you think, Carl?
We discussed the bubble a lot last year, when it was going to pop. I don't think it's shown any signs of kind of slowing down at the moment. As you said, we've seen the fastest rates of growth since 2007. Property prices have gone past 270,000, which, looking back 10 years is a huge amount.
Yeah, absolutely.
But going back to the kind of property cycle that we've discussed previously as well, it's going to go up, and on average UK house prices increase double over 10 to 15 years in the past year, so I think we'll still continue to see that growth, and that's just the property market in general, isn't it? It might slow down at some points. There are things that may impact it, inflation rates, as we've already discussed, interest rates, but there's always growth in the property market at some point. You've just got to be patient, I think, as an investor sometimes, and make sure that you're investing for the long term rather than flipping. I think that's a culture that, although is good in some regions, at the moment isn't quite as appealing due to all the costs that you've got of purchasing, as well as obviously the slow growth in some areas. I think it's just a game of patience really for a lot of people.
Yeah, absolutely. We're big advocates of spending a long time in the market, because that allows you to maximise your growth, as well as things like compound interest. So yeah, it just shows that historically it's been like this in the past. The crisis, the financial crisis saw drops, but then afterwards, London, for example, we spoke about London's decline, but following the crisis, it saw some of its biggest increases. And the same has been said for the regional areas following the pandemic. I think, prices rose by like 24,000 in 2021 alone in some of the main regions. So that's a crazy amount of growth that obviously you wouldn't have been able to experience if you just cashed out. So yeah, it's definitely a game of waiting and, trusting that your investment is going to do the work. Yeah, trusting the process.
The other thing that you've always got to remember is that it's a game of supply and demand.
Yeah.
There's a lot of cities and a lot of regions in the UK that don't have the supply needed to keep up with the demand for houses and for apartments. And I think, as long as you're investing somewhere that's got some sustainable demand and that tenants want to live there, I don't think it can ever really be put down as a kind of bad idea.
No. And then finally, the last headline is that overseas buyers continue to flock to the UK. So the number of international buyers hit its highest last year in, I think, 5 years. And that continues to be a key demographic for the UK. So the tighter restrictions in Hong Kong particularly have caused many investors there to consider alternative markets, with things like the BNO passports and obviously the potential for transactions and demand to be affected by these tighter restrictions. We have a lot more investors from Asia generally, I think, looking to UK markets. And where else do you think we could see some big increases?
I think there's a lot of appeal for the UK market for overseas investors. A lot of markets like Hong Kong, like the UAE, they're very expensive to get into for an investor. Apart from the other reasons, like you said, the tighter restrictions, the UK market is, usually quite a stable market. It's seen as quite a stable market worldwide, and a lot of investors want to put their money here and kind of see that growth that we've just discussed. I think, like you say, Hong Kong, I definitely agree there. I think those restrictions really will impact them wanting to kind of get the money into the UK and kind of drive those investments while they're kind of limited in Hong Kong. The UAE has historically over the last few years had quite a not unstable market, but it's been on kind of downward spiral a little bit, and that is recovering now, but still the UK is quite a good prospect for them. So absolutely. I think there's a lot of regions. We've had a lot of investors from South Africa who find the UK market appealing, again, for its stability. I think, again, it's probably just going to get more and more popular with the overseas investors. Yeah,
it's particularly with the rental yields, right? The yields absolutely. That you can achieve in the UK are significantly higher in places, in the UK, as opposed to places like Hong Kong, where obviously high property prices don't mean you get the returns that you're looking for. So yeah, I can only imagine that as sort of transactions fall in those areas because of the pandemic, unfortunately, that more people will be looking to alternative markets. So that concludes our January property market roundup. As always, if you want to know more about the property market in the UK or property investment in general, you can read all of the resources on our website, joseph-mews.com, or you can subscribe to our YouTube channel. Just search Joseph Mews for more educational content. Thank you.